right, welcome back. I'm Daren Blonski with Sonoma Brain Trust and Sonoma Wealth Advisors here in Sonoma. We've got Chelsie Runnings with Better Home and Gardens, Mary Piasta with Haeuser, how do I always mess this?
Piasta.
That's right. The Haeuser, Valluzzo, Piazza, right? And also LoriBeth has joined us again, our resident expert over there at the law firm on Prop 19. We're going to continue our discussion, and we've got a special guest, Nate Lamar. Nate is a CPA. Which firm are you with again, Nate?
PISENTI and BRINKER.
PISENTI and BRINKER, so a big local firm. He's going to help us on the tax side, doing some interpretation of Prop 19. We've had Nate on before. Great resource for taxes here in the county. So let's dive into Prop 19, and today we're going to take it from a tax angle. Where would you all like to start?
Nate, why don't you just give us an overview of how you see that this has changed things?
Okay, sure. There's basically three major prongs to this. First is there are two provisions that should be helpful to some. So for folks that are over 55, this allows them to purchase a new property and take their old property tax base with them. So, you know, a lot of folks that retire, they want to downsize their house, you know, the kids are all grown up and moved out, but then they bought their house in the 60s or the 70s, so, you know, they have a very low tax base. And for them to buy a new house, even if it's a downsize, would be a significant property tax increase for them. So this allows them to take their basis with them. If they, you know, buy a house over in Oakmont, which is down the street here, and they don't, you know, then they're not going to take a big tax hit on that. That same rule also applies to disabled people and those who have lost their home in a wildfire. So the benefit doesn't seem like it will be necessarily as great for fire victims, but it's out there. It allows them, if you're in a position to buy a much more expensive house, you can take your property tax basis with you, as long as you do that within 2 years of losing your home. So the other side of this, and probably the more controversial side, is Prop 19 severely limits the ability for family transfers of property to avoid property tax reassessment. So to put that another way, the old law allowed transfers from either parents or grandparents to their children, and the children would inherit their property tax basis as well. So say you know, your parents bought their house in the 60s, and they're, you know, for $40,000, you know, which you could do in Sonoma County in the 60s, then the kids would inherit that, and they'd be paying, you know, $400 a year in property tax. What this does now is it removes that ability to take the property tax base, and they will be reassessed at fair market value. So if you're, you know, you inherit your parents' house, the date that you inherit it, you will be reassessed at fair market value, and then you'll be paying property taxes based on the fair market value rather than the inherited basis. The one exclusion to that, however, is if you move into the house, you can avoid reassessment. So that's kind of the big overview. Any questions on that so far?
So this take it to the crux of the issue, right? So my parents say I have a house, or they have a house. They're going to we're trying to decide at this point, do we transfer the house to me before they die or after they die? What are the considerations I should be thinking about from a tax standpoint?
Right. So the property tax is probably a smaller issue than the capital gain, right? So if your parents gift you the house now, you inherit their tax basis. So whatever they paid for the house is now going to be your tax basis. So in, you know, same example, say they bought it for $50,000 and now it's worth $1 million. If you are gifted the property, you have a tax basis of $50,000, so that when you sell it, you're going to have to declare capital gain of $950,000, which is going to be very expensive. Now, if you inherit the property, you take a basis of fair market value. So then you turn around and sell the property, your capital gain will be zero. So, I mean, if you're looking at a reassessment, say, now you're going to be reassessed for property taxes on $1 million, that's going to cost you 10 grand a year, whereas, declaring several $100,000 in capital gain is probably going to cost you quite a bit more.
Nate, I have a question. So kind of going along with that example that you gave, my understanding that the capital gains tax rate is 15%. And so if you times that times, the amount of gain, and kind of compared it to a holding period, and then you could figure out what would make sense to how long, if you were planning to hold the property, that those two amounts would balance out. And secondarily, pretty sure that Biden's agenda includes doing away with the step up, so that would go away. So is there any kind of look or general guidance you would give to people out there weighing both of those options? Because again, right now at least, capital gains is at 15%, and you could kind of project, Chelsie would know better about the anticipated appreciation of real estate over a holding period, and you could kind of come out and say, okay, well, maybe we should do it now, or we shouldn't do it and just let the chips fall where they may, like say at the end of 10 years or something.
Right. So there's a bit to unpack there. First, I'll address the capital gains rate. So the capital gains rate currently is either 0%, 15%, or 20%, depending on how much other income you have. If the only income you have is capital gains, then you can pay 0% on that. So that's another consideration too. Just, take the year off work, quit your job for a year, make no money, and then maybe you could pay zero taxes on that. Or federal. California, it's a different story.
And so Nate, what you're saying, that's a federal. How's it work at the California state level?
So California does not distinguish between types of income. Income is income, whether it's wages or capital gains or interest or whatever. So you're going to pay between 5 and 14% California tax on whatever you do, depending on how much other income you have or how much total income you have. Generally, the highest tax rate in California kicks in over $1 million. So generally, you're probably looking at 12 to 13, up to 13.9% highest in California.
So someone who's making a reasonable income in California, which, minimal, kind of middle of the road, can even be 250, certainly here in the Bay Area, could potentially be looking at, something like a 30% plus tax on that capital gain all in.
Yep. It could be up to, probably 35 at worst case scenario between federal and state. Yeah.
So then you've really got to look at, okay, let's say if I give up my step up and then I'm going to pay that capital gain, what am I ultimately, how much am I benefiting in by saving in taxes by transferring it now, which the numbers I've looked at, it seems to be somewhere in the neighborhood of like 3 times higher than what you're currently paying. If you just let that property transition, so your taxes will increase by, say 2/3.
Right. I mean, I would say that really depends on what your plans are for the property. So if you ultimately want to sell it and cash out, it makes more sense to inherit it. But if you plan on keeping it and using it as a rental property or a second home or whatever, and the property tax increase is not a big deal. Oftentimes, rent, if you're charging rent, you can increase the rent enough to cover the additional taxes, if that's a possibility. Otherwise, again, it's really about what you want to do with the property. If you want to keep it, it might make more sense to gift it, to maintain the lower property tax rate. If you intend to sell it, it definitely makes more sense to not gift it and to inherit it at passing.
What's interesting, if you really think about the socioeconomic impacts of Prop 19, while it's certainly going to benefit schools and fire departments, ultimately, I think you're onto something, Nate, when you say pass on the increase in taxes to the renters, because I think that's what's going to happen with a lot of these rentals is they're just going to get all their rents increased. And if you look at the difference between the Prop 13 values plus what is likely to go up to, you're talking $12,000 plus easily on some of these properties. So the renters pay $1,000 more in rent per month. So that's going to have an interesting socioeconomic impact, especially in a county like Sonoma where it's already expensive to live.
But there's rent. You have to worry about, like, I saw somebody in San Francisco talking about doing that, but there's those rent caps there. And I think Sonoma County has a 10% a year you can do. So
yeah, that is a recent development.
Yeah. But I had seen somebody saying, well, I'm not worried about it because I'm going to inherit property in San Francisco and I'll just pass on the extra tax cost onto the renters. But I don't think you're going to be doing that in San Francisco.
You better go check with the rent control board in San Francisco because they ain't fun to play with from my understanding.
Yeah, certainly not going to get it all in one shot, right? Maybe, over a 10-year period, you'll get there. But
I have seen, Nate, I don't know if you have any insight on this, but I have seen people discussing doing a 1031 exchange and then purchasing the replacement property out of California to avoid California taxes. Is that even something?
That's a great question, actually. So Prop 19 applies only to California for California property. But if you own California investment property and you do a 1031 into property in another state, which you absolutely can do, California requires that you basically track that property until you resell it again, and California taxes you on the gain ultimately when you sell it. If you get out of California into another state, California is going to be watching you and making sure that you pay taxes on that California property ultimately.
Shocker.
Yep. You have to include the form in your tax return every year until you dispose of that property.
Wow.
Yeah.
Pretty draconian, actually, but
So there's a big no on that.
So if we could just circle back just for a moment on the cap on the rent increases, obviously it depends when you acquired the property as to when your base was set for your real property. You kind of harken back to the 60s and 70s and super low bases. Obviously, other people have acquired property more recently. But for those older acquired properties with super low tax bases, and you had mentioned, a tax increase of about 2/3, and you pit that against these Sonoma 10% cap for rents, it just really doesn't pencil out. You're not going to be able to recoup those rental increases. So again, it's one of those scenarios as to your specific situation. You need to look at what your tax base is, what you think market rent is, and kind of run both the scenarios of keeping versus go ahead and transferring those properties to your child, or in some cases, grandchild beneficiary.
Well, I think you raised a good point there, and I think one of the intent behind Prop 19 was to encourage more people to sell the house that they inherit rather than keeping it and renting it out, because helping with real estate inventory primarily, which is strapped in California historically, and getting a lot more out on the market. Maybe prices come down a little bit, maybe anyway, I could leave that up to Chelsie with the real estate angle, but definitely people will be encouraged to sell those properties rather than keep them. That's definitely a big part of this.
I think that was and don't crucify me because I did not join in on the $37 million lobbying part of the Association of Realtors, but I definitely think that that is the big reason behind it, is that there wasn't much motivation before for you to sell real estate when you could just pass it down to your children and keep generational wealth through it. And it really made it difficult for first-time home buyers and families to get into the real estate market in California. So hopefully, I am hopeful that if anything were to come out of this, it's just that there will be more inventory available, and it will allow families and first-time home buyers an opportunity to get into becoming a homeowner, and hopefully at a reasonable rate, because the more inventory that's available, the more prices will stabilize. So
the last piece of this goes into effect in April of 2021. So it doesn't really give us a lot of time to plan and to, make adjustments to estate plans and trust documents and all that kind of stuff. So, it'll be interesting. We'll
Well,
probably get a lot of.
You got to do it before February 15th, right?
for most February, and then the April date, Nate's right, is with respect to specific constituencies, excuse me. But yeah, February 15th is like the drop dead for most situations.
For the parent-to-child exclusion situations, for the expansion, you have more time. That's the April. That's for the folks who are 55 years and older. So there is a two different camps, and you get more options and choices if you're taking your tax base with you. You can now go to all counties. You could always do it within Sonoma County and a few other reciprocal counties. Now you have more options if you want to retire somewhere else. But in terms of this very time-sensitive passing property to your children, that is February 15th, as Daren mentioned.
Thanks for covering the tax angle for us here this morning. Appreciate it, and it's a kind of an important piece here.
Sure, my pleasure. Thanks for having me.
I'm sure we'll have to circle back with Nate in a few months to catch up on taxes, see if there's going to be any tax deadline moves or anything that we need to know about soon.
I'm sure the Biden administration has a few things up its sleeve, so we will definitely know more in the next couple months.